A very good evening, friends. So I hope you're all doing well. And of course, the obvious question which I've been asking for a couple of classes that I hope your cumulative revision on financial instruments is going on. So we started a discussion with another area on financial instruments in Indes 109, and that was with reference to derecognition of financial instruments. The concept of derecognition means a removal of the financial asset or the removal of the financial liability from the balance sheet of the company. The focus so far has been on the financial asset. We yet to discuss the derecognition of a financial liability from the books of accounts. So I've given you a three-step model in terms of deciding when the derecognition would take place. I think now we need to do a couple of questions as well. And before that, we need to consolidate the learnings as well, because I know the area is quite technical indeed. So we need to first of all take a recap, but I hope you've also made your revisions as well. So as we take a recap of the three-step model, I guess you made your revisions as well. So our focus for the day is going to be to begin with the derecognition principles of a financial asset, looking at the cash flow test, the risk and reward test, and the control test if required, and then deciding on the accounting treatment. How would the accounting take place depending upon different permutation combination? And I basically said that there are three kinds of combination. One is that there is a full derecognition. One is that there is no derecognition at all. And the third is that there is a partial derecognition, which is called the concept of a continuing involvement. And then we'll go on to the next area of discussion, that is a derecognition of financial liability. So before that, I think let's first take a little recap. Let's spend some time rewinding the inputs in terms of the three-step model, that is the test which I gave you. So let's begin the journey. And Shruti sir wanted to know a basic rule question, that why a derecognition is done. Okay, that's I think an interesting question indeed. Well, when you look at the concept of a derecognition, a removal of the asset has to be based on certain principle. And you would agree that a removal of the asset would also correspondingly change the ratio analysis as well. Now, I would also answer your question in a bit more detail. Once I'm done with the accounting for derecognition, I will be able to answer your basic question, which is a very important question indeed, that why did the standard setters introduce the concept of a derecognition? So your question is basic, but trust me, it's a very interesting question indeed. So I will definitely answer this question, but I'll give you a very detailed answer on this, that why derecognition principles have been done. So once we are able to understand the accounting for derecognition, your basic question, which is a very important and a pertinent question, will get answered. But I think it'll take me almost around an hour plus before I'll be able to answer your question in detail. But I'll certainly answer your question, and I'll come back to you within an hour's time and ask you, did you get the answer to your basic question or not? Okay. So on that note, let's, I think, start with a little quick inputs and let's consider a mind mapping. So let us first of all consider what we learned in the three-step model, and then we'll look at the permutation combinations and also dig into what is to be seen in each step. Now, we decided in terms of derecognition of financial assets. In terms of derecognition of financial assets, the concept of derecognition means that there is going to be a removal of the financial asset from the balance sheet of the company. The standard setters decided certain set of principles based on the evaluation of certain tests. When would the removal of an asset take place from the balance sheet of the company? And we decided that in this particular case, the entire process, the entire principle in terms of derecognition can be divided in terms of a three-step model to make it very easy. So at the first instance, what I need to do, I need to get on to the step number one. And in terms of the step number one, the focus is going to be on what we call the cash flow test. The focus is going to be on the cash flow test. The step number one, as we decided, goes in a sequence where you need to apply the step number one, A, B, and then C. I'm yet to talk in terms of C as well. So we need to first of all go to the step number A and see have the cash flows expired or not. Now, when we use the word that the cash flows have expired, to remind you, we decided that whatever is legally due to be received, you've already received. So there is nothing more what you can receive from the asset, or it is a case of an F&F, what we call a full and final settlement. You sat down, for example, with your debtor and you did a full and final settlement. So whatever is legally due to be recovered is already recovered. So there is nothing more which you can get. So in that case, we can say that yes, the cash flows have expired. Now, if I say yes, the cash flows have expired, then in that particular case, you're ready to go for a derecognition. No further evaluations are required to be done. So the moment you say that whatever is legally due to be recovered is being recovered, then in that particular case, it's a simple case of a derecognition and it's going to be a full derecognition. Now, if you say no, it is not expired, then I need to go to the step number 1B. And in this particular case, in step number 1B, we're going to say, okay, that have you transferred the cash flows or not? Have you transferred the cash flows or not? Now, when you focus in terms of the cash flows being transferred, I would say the transfer would take place in one of the three forms. Either when you sell a financial asset, it is as good as a transfer because I am passing on the rights to receive the cash flows to another person. They're not expiring, but you've only transferred the cash flows to another party. Or it could be, for example, a signing of your trade receivables to a factoring agency. Or it could also be a case of a simple bill receivable discounting. So I would say when you're looking in terms of cash flow transferred, the three examples which should come to your mind is that there is a sale of financial asset. So the moment a question says that there is a sale, I'll consider yes, the cash flows transferred. Or there is a case of assigning the trade receivables to a factoring agency. So assigning of the account receivables to a factoring agency, or it is a simple case of a bill receivable being discounted. So can there be more examples of cash flows being transferred? Yes. Is this an exhaustive list in terms of transfer? No. But I am focusing from the examination point of view in terms of these three areas, which will cover up all the questions which are there. So you can say that if it is not a case of expiry, certainly it will fall under any one of the three parameters, that it is a sale, or it is assigning a trade receivable, or it is a bill receivable discounting. If any of these three are there, I would say it is transferred, and I would say yes, they've been transferred. So when you say yes, they've been transferred, then in this particular case, it is time to go to the step number 2. Then it is time to go on to the step number 2. If you say yes, that means we need to conduct a risk and reward test. But if you say no, then I need to go to step number 1C, which is still pending. But don't worry, we're going to talk of this very soon. So I hope the concept of the cash flow test so far is very clear. I am clear with what is expiry. What I am legally due to receive is already received. Now, there are no further cash flows which can be generated from the financial asset. A complete, full and final settlement is done. And when I say a transfer, what should immediately come to your mind is these three agendas. Right, friends? I hope if any questions coming so far, do ask me. I hope I'm pretty clear on this agenda. Okay, Shruti said a partial derecognition means partially it will be related and partially it will be transferred. Yes, you can say that. But how would exactly a partial derecognition happen? That, of course, we'll be able to appreciate more when we come to the practical part of the accounting. So far, so good. I guess we have understood expiry and we have understood what is transfer. So when I go to the questions, We will evaluate the cash flow test, read the language of the question and say, okay, is it a case of expiry or is it a case of transfer? Now, I'm theoretically putting that step number C at the moment, that if you say it is not transferred, it could be a case of what we call a PTA, that is a pass-through arrangement, which I am yet to discuss. So I think let's keep that pending. But if it is a pass-through arrangement, I'll again go to the step number 2. And if not, then you continue the asset. So I think let's keep that PTA pending for some time. So we'll be discussing this a bit later today. So my step number 1 is pretty clear. So when I read the language of the question, per se, forget about PTA. You got to evaluate number 1. Is it a case of expiry or is it a case of transfer? Simply, that's it. PTA, no worry, we're going to look at that. So far so good. Do let me know if everything is pretty clear till this stage. Now, let's go to the next step. The second step, once you say the cash flows are transferred, you go to the step number 2, where the focus in terms of step number 2 is in terms of risk and a reward test. It is in terms of a risk and a reward test. Now, when you're conducting a risk and reward test, I would say your risk and reward test is to be conducted with reference to these 3 situations. Because you're going to conduct a risk and reward test only if the cash flows have been transferred and not expired. Mind the words carefully. So you're going to consider the evaluation of the risk and reward only when the cash flows are transferred, which means in all these 3 cases, you need to evaluate the risk and the reward test. So we'll make a walkthrough in terms of all these 3 and try to remember that what kind of permutation combinations could arise. Now, in terms of the risk and reward test, there are no sub-steps, but there are going to be possibilities which will help us to decide what kind of permutations and combinations could arise. So when you're going to conduct a risk and reward test, there are 3 permutations, combinations, or we can say the possibilities which could trigger. Either we will say that yes, it has been substantially transferred, or we will say that it is substantially retained, or we will say that it is neither substantially transferred nor it is substantially retained. It's a mixed situation between the 2. So the concern which comes to the mind is that when you're looking at whether the risk and reward is substantially transferred or retained, what are the parameters which will help us to decide that? So once we make a walkthrough in terms of all these 3 permutation combination, we will be able to easily understand this. So once you evaluate this part, if you say it is substantially transferred, it is time to go for a derecognition. And this will also be a case of a full derecognition. If you say that it is substantially retained, then you need to continue the asset in the books of accounts. The financial asset cannot be removed and it is continued in the books of accounts in which the sale or the amount which is received on assigning the trade receivable or the amount received on the bill discounted. Mind the words very carefully. So if you say that the risk and reward is substantially retained, the amount received on the sale, the amount received from the factoring agency, or the amount received on account of the bill receivable discounted is going to become a financial liability. Because in any case, the cash flows are transferred and you must be getting some money, you must be getting some cash flows. But if it does not become a case of a derecognition, then in this particular case, it will give rise to a financial liability in the books of accounts for the consideration received. And then when you say it is neither, it is only in this particular case that you need to go to the step number 3. Now, before we go to the step number 3, let us evaluate these combinations with reference to the 3 situations so that we're very clear. I'm spending a little time because the mind is a bit fresh and I want to consolidate before I trigger the accounting treatment. I think it's going to be definitely helpful. Though it might take me a little 10-15 minutes extra, but I think it's worth it, because if you don't understand the movement of this chart, you may not get a catch in terms of derecognition. I guess so far so good. So we are now going to make a walkthrough on the second step. Yes, clear till this stage. That's wonderful indeed. Now, let me just take you further and let's go on in specific. Now we are going on in specific to the step number two. The three cases when the cash flows are transferred. The three cases when the cash flows are transferred is in terms of a sale, is in terms of a factoring agency assigning a receivable, and is in terms of that you are going to, go in for a bill receivable discounting. So when you look at the case of a cash flow transfer, I would say that there are a total of three situations what is coming to my mind. The cash flows could be transferred on account of three factors. One is you can say that a bill receivable is discounted. One is that a bill receivable is discounted. The other one is that you assign your trade receivable. You assign your trade receivables to a factoring agency. And the third is that you have gone in for a sale of a financial asset. Now, the standard has given us a lot of clarifications in terms of what kind of permutations, combinations could occur in terms of all these cases. Now, when you concentrate in terms of the fact that the bill receivable is discounted, the possibilities which can arise is that is it with a recourse or is it with a non-recourse? The possibilities which could arise is that is it with a recourse or is it with a non-recourse? Now, what does a recourse or a non-recourse mean? When I approach a bank and I say, I want to get my bill discounted, they would pay me the money at this stage. And when they say it's a recourse, which means if my debtor doesn't pay, then the bank is going to catch me. And trust me, as far as a bill receiver is concerned, it is never, generally never with a non-recourse. The bank would always discount a bill of exchange, and we would say that the banker would say that if your customer fails to pay the money, you are going to make the money good. So which means that in terms of a bill receivable discounted, it is always with a recourse, which means the bankers can always come back to you. And if the bankers can come back to you in this particular case, we can undoubtedly say the risk and reward is not transferred to the bank. So when you get your bill discounted, you would have transferred the right to receive the cash flows to the company, that is to the banking company, but the risk and reward is not transferred. We can easily connect and say that the risk and reward is supposed to be substantially retained. And if it is substantially retained, you need to continue the asset in the books of accounts. So does this mean the journal entry which used to pass in school, putting the entry bank account debit and the bill receivable being given a credit, was that incorrect? Yes, it is incorrect as per Indian accounting standards. It is correct as per the ICAI, but if I look as per the Ind AS, it is not correct. So in this particular case, as I just said a few minutes back, that if you are going to continue the asset in the books of accounts, then what is the entry which I'm going to pass at this stage? So when you get your bill discounted, I would say, let me put the entry bank account debit and give a credit to the financial liability. And at this stage, let me also tell you and recall that when we did the 5 categories of financial liability, I made it very clear that there is one liability which we say a financial liability is recognized when the financial asset is not eligible for derecognition. And you can see in this particular case, the financial asset is not eligible for derecognition, and therefore it is giving rise to a financial liability. So this was the example of a financial liability which arises when a particular financial asset like bill receivable is not eligible for derecognition. It fails the derecognition principles and therefore an FL is take. Okay, so this is one aspect. Now we go to the second aspect. You assign your trade receivables to a factoring agency. Now, when you assign your trade receivables to a factoring agency, there could be different kinds of arrangement you could enter into with a factoring agency. So one of the arrangements you could enter is that there is a recourse And the other kind of arrangement could be that it is a non-recourse. And there could be another kind of arrangement as well, and that is that there is a recourse, but the recourse is with a certain upper limit. There is a recourse which is with a certain upper limit. So as a company, I went to the factoring agency and I said, you take my debtors and give me money. And the factor tells me that if your customer doesn't pay, then you are going to be responsible for the bad debts. That is a recourse. Or the factoring agency tells me that if your customer doesn't pay, don't get worried. It's our problem. We will take care. If the arrangement is non-recourse in nature, I think it clearly implies that I passed on my risk and reward to the factoring agency. And if it is supposed to be a recourse, it indicates that the risk and reward is still there with me as a company. So if it is going to be a recourse, we can certainly say that it is the same situation, that the risk is substantially retained and you would continue the asset. So whatever money you get from the factoring agency is going to be put as bank debit FL. The debtors would continue in the books of accounts itself. And if it is a case of a non-recourse, then I would say yes, the risk and reward is substantially transferred. And if it is substantially transferred, we can go in for a derecognition. And when you say that we are going to go for a derecognition, this means a complete derecognition. So am I going to put the entry, bank will be given a debit, the debtors will be given a credit? Yes. I'm going to put an entry derecognizing the financial assets in the books of accounts. And don't worry, I will come to the logic also why the standard setters actually decided in terms of saying that recognize an FL or derecognize an FA. There is a good logic. But for that, we need to first appreciate the accounting treatment. Then I'll give you the comparatives. Now coming to the third situation, that in this case, I went to the factoring agency and they said it is a recourse, but I said that I can be made responsible only for a certain amount. So the risk and reward in this case is neither completely transferred to the agency, nor it is completely there with me, because we have decided to bear a risk up to a certain limit. So it is difficult to say that is the risk and reward being completely transferred substantially or it is substantially retained. So this would be a case of a situation where it is neither completely transferred nor it is retained. So we need to go to the step number 3 and identify the control test. I hope I'm clear on that picture as well as far as the risk and reward on assigning is concerned. So when you go to see a practical illustration, watch out. Is it a case of a bill receivable discounting? Then you need know what you need to see. If it is a case of assigning your trade receivables, you will know how do I proceed in terms of risk and reward evaluation. Now comes the third input, that if it is a case of a sale, then what am I supposed to do? And we did a huge number of permutations, combinations. When it was a case of sale, we did a huge permutations combination. I hope you're understanding the flow. If you've made your revisions on the previous class, I'm pretty sure you're going to get a complete thought process clear. Okay, Shruti said, so can you explain the entry of continuation of the asset, bank debit and financial liability is given a credit? Okay. Well, let me first of all come back to the position. Let's say, for example, you got a bill receivable discounted. Now, if you got a bill receivable discounted, you went to the bankers and they definitely paid you money. Now, when they paid you money, I'm saying you can't derecognize the asset. The asset needs to continue in the books of accounts. So what do you do with the consideration you received from the bank? Is it indirectly the bank is giving you a loan and they are keeping your bill of exchange as a security against the loan given? I would say yes. So in this particular case, when you get a bill discounted from the bank, why should you treat that you made a transfer of the asset? You should rather treat that you gave them a bill of exchange as a security and in return, they give you a loan. So indirectly, it's not a discounting a bill. Indirectly, it's taking a loan. So you're putting the entry bank debit and FL credit for the consideration received. So if you look at in substance, it is not supposed to be discounting a bill. It is in substance giving them a bill as a security and in return getting a loan. So we can say it is a case of FN, a loan that is a financial liability, right? I guess that answers that question, right? Okay, now let's come back to the next agenda, that if it is a case of sale. Now we saw that there could be a lot of combinations in terms of sale. There could be a lot of combinations in terms of sale. Now, when you're looking in terms of the sale, there can be a couple of combinations which we need to see. The combinations are, it could be an unconditional sale. The combinations could be that it is an unconditional sale. Or the other combination is that it is a sale. The other combination is that it is a sale, and along with this, you've also entered into a repurchase agreement. So along with the sale, you've also entered into a repurchase agreement. Or the third combinations which you could see is that there is a sale, and along with this, you've also entered into option contract, which gives you an option to buy or sell, whatever. So we'll come to that one by one. So when you see that it is a case of a sale, I made a sale of a financial asset to a party and it is completely unconditional in nature. So the standard makes it very clear that if it is a case of an unconditional sale, you can certainly say that the risk and reward is substantially transferred. When you make a sale of the asset and it is without any ifs and buts, it is an unconditional sale. The standard in the appendix of 109 clearly says that this is a case where the risk and reward is transferred. So you can go in for a derecognition. You can pass the entry with a full derecognition, that is bank debit, and the financial asset will be given a credit, and the corresponding gain or loss would depend upon the category of financial asset. The other situation is that if it is a sale with a repurchase agreement. Now, this is a situation when I made a sale to someone and I also said that I'm also going to make a repurchase back. So today I'm selling you the asset, but tomorrow I'm going to buy this asset back from you. So in this case, the standard says that there are two permutations combination, that as far as the repurchase price is concerned, as far as the repurchase price is concerned, the repurchase price is fixed at a fair value, or the repurchase price is supposed to be fixed at, you can say, a selling price plus a lender's return. It is fixed at a selling price plus a lender's return, or it is supposed to be a fixed price, or it is supposed to be a fixed price. So when you look at that there is a sale and a repurchase agreement, in this particular case, when you look at a sale and a repurchase agreement, you need to first of all watch out and evaluate that in this case, the repurchase price is either at a fair value, or the repurchase price is a selling price plus a lender's return, or is it equal to, you can say, a fixed price. Now, we need to understand that in which permutation combinations would we say the risk and reward is substantially transferred or it is substantially retained. Now, if you say that I made a sale to someone and I'm saying I've got a right to repurchase it back. I made a sale and I've got a right to repurchase, and I'm going to make a repurchase at the fair value which prevails at the time of repurchase. Do you think I've got incentive enough to repurchase the asset? If I'm going to repurchase the asset at a fair value, it's available in the open market at the same price. So what kind of incentive would I have? I have no incentive to repurchase. So even though there is a repurchase, but since the repurchase at a fair value, there is no incentive for the person, the seller, that is going to repurchase. So in this particular case, considering that the repurchase is not going to occur, considering that the repurchase is not going to occur, we can say that the risk and reward is substantially transferred. And if the risk and reward is substantially transferred, we will go in for a derecognition of the financial asset. The other combination which comes is that the repurchase price is fixed at a certain price. It's like this. Imagine that as Mr. A, I sold goods to Mr. B for 1 lakh. And then I said, I will repurchase this at 1 lakh 20. So when I made a sale to Mr. B at 1 lakh, I took 1 lakh from him. And when I repurchase, I give him 1 lakh 20 back again. And if I'm going to give him 1 lakh 20,000 back again, then in this particular case, it's more like a loan arrangement. It's more like a loan. Imagine I make a sale to someone at 1 lakh rupee. I get that 1 lakh rupees and then I repurchase and give him 1 lakh 20. It is indirectly taking a loan and give the money back with an interest. So in this particular case, the apparent sale agreement is not exactly a sale agreement. There is no intention of actually making a sale. And if there is no intention of actually making a sale, in this particular case, the risk and reward is not transferred. And we would say the risk and reward is supposed to be substantially retained in this case. And if it is substantially retained, then it is continued. The asset is going to be continued in the books of accounts. So I hope you'll be able to catch up with the entire movements which are there, how the risk and reward situations are going to be evaluated under various permutations and combinations. Then comes another situation in terms of a sale along with an option. Now, this is something we need to be careful on. So when I say there is an option, you need to first of all understand one very important input, and that is, if I make a sale to someone and I've got the right to buy it back, then I would say it's a long call. So the combination could work something like this, that I make a sale and that sale is made along with a right to buy. So when you say that there is a right to buy in terms of option, it is called a long call. So basically, to repurchase, I could enter into a long call. I sell and then I got the right to buy. That's a long call. Alternatively, I can tell B that you go for a long put. So as A, either I say I'll take a long call, I'll get the right to buy it back from B, or I tell B that you go for a long put, you get the right to sell me. If I'm under a right, he gets a right to sell me, then I'm under an obligation to buy, which means I'm under a short put. So this option which you can enter into could be a combination of a long call with a right to buy, or it could be a short put with an obligation to buy. With an obligation to buy, because the other person has got the right to sell it to you, and you've got an obligation to buy it back, so you take a short put. So which means a sale with a long call or a sale with a short put can be a combination. So either I made a sale with a long call, right to buy, or it is a sale where the other person got a right to sell me. So for me, it becomes a short put. Now, in this particular case, I would say it all depends upon, what kind of situations would happen. Because we know that in terms of option contract, the option contracts may be in money, at money, out of money, or it could be deeply in or deeply out of money. So the combinations which could occur in terms of these options contract can be that it is supposed to be deeply in money. It could be something we can say is deeply in money. So we evaluate and we say that yes, it is deeply in money. Deeply in money means that you're going to definitely exercise. Or it could be a situation where you say that it is deeply out of money, which means you're definitely not going to exercise. Or it could be a situation which is a little bit subjective. It can be in money, or it can be out money, or it can be at money. So when it is in, at, out money, you can't be very sure that you will not exercise or you will exercise. It is only in a situation when the option is deeply in money, you know that you will exercise, or it is deeply out of money, you know that you're not going to exercise. But if it is in, at, out money, then in those situations, we can say you're not pretty sure. So now let's evaluate that if the positions in these options turn out like this. So when I say it is deeply in, so today I made a sale to someone and my option is deeply in money. That means I'll definitely buy it back. If I'm going to buy it back, then in substance, a sale never took place. So I would say in this particular case, you can say the risk and reward is substantially retained because you never transferred the asset. Because you're going to make a repurchase back. So it means that the risk and reward is substantially retained. And if it is retained, you need to continue the asset in the books, which means for the amount received on the sale, you're going to put an entry financial liability. Because you're going to get some money on a sale, but I would say that that money received is going to be a financial liability. Now, when you say that the option is supposed to be deeply out of money, this means that I will not repurchase. I made a sale today and it is deeply out of money. I've got no intentions to buy it back, which means the repurchase will never be exercised. And if the repurchase is never exercised, it means that the risk and reward is substantially transferred. And if it is substantially transferred, it's a case of complete derecognition. And finally, you can make a guess if your mind is working clear that if you're looking in terms of in at out money, if you're looking in terms of in at out money, I can't really say that I'm going to buy it back or not. I can't say, I might say, maybe, maybe not. And if it is the case of maybe or maybe not, then we can say it becomes a case that it is neither transferred nor substantially retained, which means you need to go to the step number 3 in this particular case. So this is in detail the risk and the reward test conducted. So you can now see that I've conducted the risk and reward in a very systematic manner. I've taken the bill receivable discounted assessment risk and reward, the assignment of the trade receivables risk and reward, and I've taken the combinations of a sales with different permutation combination, the risk and reward. I'm pretty sure that if you made your revisions and today with this particular consolidation, I'm sure you would be getting a good clarity and a chronological order of thoughts. I think so. I think so. Okay, Claire, thank you. That's great. Prashant, so in repurchase price, it says in repurchase price is more than the fair value, then still the asset is substantially retained. If in the repurchase there is a fixed price is more than the fair value. Well, in that particular case, you see, if you've already pre-decided a fixed price, that means that you must have already decided a lender's return. Nobody would agree to a fixed return because unless we know that it is bound to be exercised. So if you're looking in terms of the combination, that it is at a fixed price, I would say this is something which they mutually agreed with each other. If they mutually agreed with each other, the possibilities is that the fixed price is as good as the selling price plus a lender's return, considering it's a loan arrangement. That's what the standard setters thought, that if you're fixing a price, then that fixed price, which is of course not the fair value, but it is as good as the lender's return, right? Okay, that's done. And I think Manmo is asking me whether the law class will start. I don't know. Okay, Shruti, so for partial derecognition, the entry should be combination of a full derecognition and continuation of an asset. Yes, you're going to see that. However, the second entry is different. That is financial asset debit, financial liability. Now, don't get worried on what are the entries in terms of partial derecognition. That chain will also become very clear. I would say another half an hour, 45 minutes, you will get a full clarity, 100% guaranteed. Terms and conditions apply. I have a complete intention of giving you this chain of thought in a go so that you are able to understand the practical question in terms of the principles of derecognition and then the accounting. So I think it's going to be almost 6:40. So wait till almost 7:30. You're going to get a full confidence. I'll take your scores of comfort zones almost around that time. And I'm pretty sure it would be at least around a 7 to 8, at least. Okay, so this is on the risk and reward test. Now let's come back. So I've done a detailed input in terms of risk and reward evaluations as well. Now we come to the step number 3. And when I come to the step number 3, the focus is in terms of control test. And the control test is only going to be applied when the risk and reward leads to a neither kind of a situation. When you're in a situation where you say neither, then only the step number 3 is going to get triggered. So in this particular case, your focus is on the control test. The focus is in terms of the control test. And here also we have got possibilities. Here also we have got possibilities, and they're not sub-step. The sub-steps are only in step number one. Rest in step two, in step three, there are only possibilities which are working. And the two possibility is that the control is transferred or the control is retained. So when you say the control is transferred, it is time for going in for derecognition, which is again a complete derecognition, a full derecognition. But if you say it is retained, I would say it is not a case of a derecognition, but it is a case of a partial derecognition. So this is the only situation where a partial derecognition would take place. And when I say partial derecognition, it is also called the concept of continuing involvement. It is also called the concept of continuing involvement. So either I say it's a partial derecognition, or we would say that it is a case of a continuing involvement in the asset. Now, the only thing which comes to the mind is that when you're looking at a control test, how do you evaluate a control test? Now, in terms of the control test, we are now going to make a walkthrough simply in terms of say. Now, you would actually tell me, sir, why don't you make a control test assessment in all the three permutations combination? Well, in a bill receivable discounted, you cannot reach a control test. In terms of a signing of a trade receivable, you can reach a control test. And in terms of a sale also, you can reach a control test. So let's do one thing. Let's consider the case of, let's say, a sale with an option. So let's consider this as a base, a sale with an option where you enter, you can say the step number 3. So let's do one thing. Let's go to the combination. We are working in terms of the step number 3, where I'm looking at the control test. And this is being seen only in a specific situation. This is being seen only in a specific situation. And the specific situation in terms of control test is there was a sale and there was, let's say, a long call, or there was supposed to be a short put. So let's consider this was the case and it was supposed to be in money or at money or out of money. So let's consider that this is the permutation combination where we're looking in terms of the control test. So let's say Mr. A made a sale of an investment to B. Let's say Mr. A made a sale of investment to Mr. B, the cash flows are transferred, and A also has entered into a long call option to buy the investment back from B. Now, in this particular case, let's see how the control assessment test is going to be done. So let's consider that there is Mr. A and let's consider there is Mr. B. So Mr. A made a sale of the investment to Mr. B. And along with this, he also enters into a long call. He also enters into a long call so that he is able to buy that investment back from B. So this is a situation where A made a sale of investment to B and is also entered into a long call option that he's going to buy the asset back from Mr. B. Now, in this particular case, the focus on the control test is on B. The focus on the control test is in terms of B. When A made a sale of investment to B, B got that investment. Now, in terms of the control test, I need to evaluate, is he in a position to make a further sale or not? I need to see that would he be in a position to make a further sale of this investment? Is he free to take a decision? Is he free to take a decision? Does he have a control over the asset? And I decide, no, I can make a further sale. Now, it depends in this given circumstance, it depends upon the fact that there is an active market for that security, or let's say there is no active market for this particular security. So we can say that in this specific situation, we need to basically see that is there an active market for the security. Now imagine A made a sale of a security to B, and B is able to make a sale further. And tomorrow A says, give me the investment back. I've got a long call option. I want to buy it back. Mr. B can go in the active market. He can buy the asset and give it back to A. So the presence of the active market would mean that the control test in this case will pass. That means the risk and reward is substantially transferred. But imagine if Mr. A sells a security to B, which is not traded in the active market, and B makes a further sale. And tomorrow, if A comes back to B and say that I want the investment, where is he going to get that investment? So if there is no active market, then we can say that B may not be in a position to make a further sale, and the control test is going to fail. And we're going to say that the risk and reward is substantially retained in this particular case, but we will still be able to do a partial derecognition. So in this particular case, when the control test will pass, I will go for a derecognition, and if the control test will fail, we will be able to go in for a partial derecognition. So that was the entire walkthrough in terms of understanding the cash flow test, and then considering the risk and reward test and the control test if required, which we saw only in one typical situation, sale with a long call. I hope now the entire chain in terms of applying the principles of derecognition is clear. Now, before we go to the case of PTA, which I'll do later, I think it's time first to give you exposure on the kind of accounting, because once you get the exposure in terms of accounting, you will truly understand the entire concept. Okay, so far so good. I hope everybody is well understood with this. Okay, now I think let's take this further. I'm not going to go to the accounting part. But remember one simple thing before I go to the accounting part. Just a little input further before we go to the next input. You've got step 1, and you've got step 2, and you've got step 3. Just remember one very important principle which stems out of all our discussion. And that is, if the cash flow test, you say that they've expired, if they've expired, it is a case of 100% derecognition. If you say they've been transferred, you go to the step number 2, and if the risk and reward in this particular case is substantially transferred, or it is substantially retained, or it is neither. When you say it is substantially transferred, then also it is a case of 100% derecognition. When it is retained, then you continue, and when you continue, it is a case of recognizing a financial liability. And if it is neither, you go to the control test. So you meet the step 1 expiry full derecognition, you meet step 2 full derecognition, you don't meet step 2, it is a continuation, and if it is blend, you go to the control test. And in this particular case, when you apply the control test, then you look at the situation that either it is transferred or it is retained. If it is transferred, it is again 100% derecognition, and if it is retained, then it is a partial derecognition. So we can very clearly see out of all the permutations, combinations, that they are effectively, you can say, 3 kinds of accountings which are coming in. Either it is a case of 100% derecognition, or a case of continuation, or it is a case of partial derecognition. Any permutation combinations of applying the principles could lead to a full derecognition or a partial derecognition, or it could lead to a case where you continue. I think now we're in a very comfortable position. So what I'm going to do, I'm going to read the question, and we're going to apply the 3-step model. Rather, you're going to apply a 3-step model. If you can answer this, then I think the concepts are going great and superb. Okay, so I think I've spent a good time, but I hope the time spent has been worth it. Because I think if I have not consolidated all this technical picture, then applying the accounting would have been a grave task. This chart already covered. I'll be coming to the concept of this PTA later, but let's now bring you to an accounting treatment. So I'm going to take you to the accounting treatment directly. Now let's have a look at the accounting treatment and see. So let's, I think, take you to the accounting treatment. Let's directly go to a practical illustration. Let's have a look at a practical illustration. So I'm looking at the illustration number 11. I'm looking at the illustration number 11, where we're going to look at the aspect of how and what kind of accounting would apply. So I'm going to read the illustration. We're going to apply the three-step model. You would apply and tell me the kind of accounting applicable. It says ST assigns the trade receivable. It assigns the trade receivable. Keep giving me answers, friends. If you assign your trade receivable, what is going at the back of your mind? So what is going at the back of the mind when you say that it is assigning the trade receivable? What goes at the back of the mind in terms of your cash flow test? I'm looking at the step number 1 and I'm looking at the cash flow test. What is going at the back of the mind? Can I simply conclude that it is trustworthy? Because I very clearly gave you that a sale and assigning of the trade receivable, a discounting of the bill of exchange is indicative that you have trustworthy. So when it says S assigns the trade receivable, trustworthy. So what do? You need to go to the second step, and that is a risk and a reward test. Now, please give your answers. If you make your assessments, do give me your answer. Let me understand whether you're able to apply the principles learned in the practical illustration. Then he says the carrying amount of the receivables. I'm given the book value. The carrying amount of the receivables is 10 lakh and the consideration received is 9 lakh. Customers have been instructed to deposit the amount directly in a bank account of the benefit of AT. AT has got no recourse to ST in case of any shortfalls in collection. Aha. I think he's very clearly telling you that AT has got no recourse. So when it says that AT has got no recourse, so I am clearly given that in this particular case, the factoring agency has got no recourse in terms of this. I think you can decide. You can decide in this particular case, if they've got no recourse, that means the risk and reward is done what? The risk and reward in this case is substantially trustworthy. The risk and reward is substantially trustworthy. And if you say the risk and reward is trustworthy, it is time to go in for a de-recognition. So we don't need to go to the step number 3. The conclusion is clear that we will go in for a de-recognition, and that is supposed to be a full de-recognition. So what does this mean? That when I assigned my debtors into a factoring agency with a known recourse, can I put the entry bank debit with the consideration received? Debtors is given a credit, de-recognizing the debtors. And if there is any difference in the entry, that's a gain or loss arising on assignment. Yes. So it says out here, state whether the de-recognition principles will be applied or not. And the answer is yes, the de-recognition principles would certainly apply. So in this particular case, let's also make a walkthrough on the accounting treatment. So can I say the accounting treatment would be, you will put the entry bank account debit with the consideration received. So we've received a consideration of 9 lakhs on assignment. And the debtors, that is a financial asset, is given a complete de-recognition. You remove the debtors out of the books of accounts, and there is a balancing figure which is 1 lakh rupee in the entry, and that is going to be debited in the P&L, represents a loss arising on a de-recognition. Let's, I think, also read what is stated in the illustration, though I've given you the entry, but I think let's read. In this situation, ST has transferred the rights to contractual cash flows and has also transferred substantially all the risk and rewards, the credit risk being the most significant risk in this situation. The credit risk means the risk of default. If the other person says it's a non-recourse, I have got no credit risk, and when you transfer the credit risk to the other party, it's a complete transfer of risk and reward. Accordingly, ST de-recognizes the financial asset, recognizes 1 lakh, the difference between the consideration and the book value, as an expense in the statement of P&L. You would say the question is pretty easy, but trust me, if you're able to correlate the three-step model with the accounting treatment, I think you've well understood the concept. I think so. Okay, so this was case one. Can I say this was a case of, you can say, 100% derecognition. This is how the accounting which takes place, a complete derecognition. Let's have a look at the second case now. Well, we do not have any entries, any example which is given, but it says transfers that do not qualify for derecognition. But I think I've already said that transfers which do not apply derecognition, you put the entry bank debit FL credit, the consideration received. So I think let me put it out here. It says continue to recognize the asset in its entirety, recognize a financial liability for the consideration received at a fair value less the TC. That's what you do. When you recognize a financial liability, the financial liability is always taken at an initial recognition at a fair value minus the TC. And then it says this liability is subsequently measured at AC using EIR. So which means if it is a case of a no derecognition, you are putting the entry that is bank account debit, and the financial liability is given a credit with the asset completely continuing. A bill receivable discounted, you put this entry. Assigning the trade receivables with a recourse, you put this entry. A sale which is supposed to be, a sale with accommodations of long call and long puts, well, you know that they're deeply in money, you put this entry. You receive a consideration on the sale, you receive a consideration on discounting the bill, you receive the consideration in terms of the assignment of the trade receivable and the failure in terms of risk and reward, the consideration received, bank debit, and the financial liability taken. Then comes the third, permutation and combination. So now this is the third one. It says continuing involvement in the transferred asset, that is called a partial derecognition. When does a partial derecognition apply? It would apply when you fail the risk and reward and you go to the control test. Let's have a look. Let's have a look at a practical illustration which is given, illustration number 12A, which is explaining how the partial derecognition is going to take place. So let's make a walkthrough in terms of a partial derecognition. First, we'll apply the principles for derecognition and zero down that is it a partial derecognition, and then we're going to look at the accounting. Let's have a look. It says entity C agrees with a factoring company to enter into a debt factoring arrangement. So you are entering into an arrangement which is supposed to be assigning your trade receivables to a factoring agency. If you want to give your answers, keep giving me the answers, friends. So in this particular case, if I were to put across and apply my three-step model in terms of step number one, that is on the cash flows, I would say they are transferred. You're assigning your trade receivables to a factoring agency, the cash flow transferred. So you go on to the step number two. And in terms of step number two, we're going to look at the risk and the reward test and see, is it transferred, retained, or whatever. Let's read further. So I am given further inputs out here. It says under the terms of the arrangement, the factoring company agrees to pay 91.5 crores less a service fee, which is 1.5 crores, and they will basically give you 90 crores. So they said, we'll give you 91.5, but since a factor is giving you a service, he would also take a service fee at the initial recognition. So he says, I'm going to reduce my fee and give you 90 crores in exchange for 100% of the cash flows from the short-term receivable. The face value of this is 100 crores, but the book value is 95 crores. It means that they might have created already a provision for doubtful debts to the extent of 5 crores in the books. My debtors have got a book value 95, though the face value is 100, which means that this is the gross amount and this is the net amount. So you must have created a provision of 5 crores in the books of accounts. Now see further. The customers will be instructed to pay the amount into the bank account of the factoring company. C also writes a guarantee to the factoring company under which it will reimburse any credit losses. Credit losses means the bad debts. So the company entering the arrangement with a factoring agency tells him, I give you a guarantee, boss, and I will reimburse you any credit losses up to 5 crores over and above the expected credit loss of 5 crore. They were already expecting a bad debt of 5. They said that this 5 crores is something which we already expect. I am giving you a guarantee that I will bear a further 5 crores over and above that 5 crores. The guarantee is estimated to have got a fair value of 0.5 crores. Calculate the amount of continuing involvement asset. Now, if you evaluate the derecognition principles in this case, and you decide that in this case, what is happening to the risk and reward? Have you substantially transferred the risk and reward? I would say no. Have you substantially retained the risk and rewards? I would say no. My liability as a company is being restricted. I am with a recourse arrangement. I am with a recourse arrangement, but there is a limit up to which I'm going to bear an amount. And the limit is set that I will pay 5 crores over and above that 5 crores which I'm expecting. Now, since you can say it is a recourse with a limit, you can say that it is a recourse with a guarantee, or you can say a limit beyond which I'm not responsible. I can't say that I have transferred the risk substantially. I can't say that I have retained the risk substantially. So what happens in this case? I would say it is neither transferred nor substantially retained. Which means I'm supposed to go to the step number 3. And if I go to the step number 3 in this case, I am going to go to the control test in this particular case. And in this particular case, if I go to the control test, now this is a case of assigning the receivables. And in this particular case, do you think the factoring agency will have decision-making rights in this particular case? It says the customers will be instructed to pay the amount in the bank account of the company, but he also writes a guarantee. So I think in this particular case, the entire decisions may not be with the factoring agency. You cannot really say that the control is being completely transferred to the factoring agency, that the factoring agency will be in a complete control of things. They may not be in a complete control because I'm a guarantor as well. So I would not allow him to take any kind of decisions he wants. Because after all, I stand a guarantee to the amount of credit losses. So this would mean that the control is retained. If the control is retained, this is going to give me an accounting treatment, which is called a partial derecognition. Which, in other words, we said is a case of a continuing involvement. I hope you've been able to map up the 3-step model in terms of deciding why a partial derecognition is applicable. I hope I am clear, friends, at that. Okay, so that's right. Step 1, step 2, recourse and substantially transferred. Wonderful indeed. I think now you must be getting a bit more confidence in terms of how the derecognition principles are being applied. Now we need to concentrate completely on the derecognition, the partial derecognition accounting. After the partial derecognition accounting, I need to go back to the PTA, and then I need to explain the basic question that why a derecognition principles are being applied, the larger picture, why the standard setters introduced the concept of derecognition parameters. Okay. Now watch this carefully. Watch this carefully. I'm going to take you a little ahead. I'm going to take you a little ahead and jumping to illustration 12C, which is an extension of this illustration itself. I'm taking a little jump and I'm jumping to the illustration 12C in this particular case. And I would explain the entry rest 12 ABC indirectly all gets taken care. Now watch this carefully. This is a single entry which is being done in terms of a partial derecognition. Now remember the facts. My book value of the debtors is 95 crores. The factoring agency paid me a total of 90 crores after reducing the service fee, because he said, I'll give you 91.5 crores minus my service fee of 1.5. He gave me 90 crores. So what I'm going to do, I'm going to split this entry. So let me put the entry for a complete derecognition. You mind the words. I said, let me put the entry for a complete derecognition. Though it is not a case of a complete derecognition, but a partial derecognition. But let's first put the entry for a complete derecognition. So you get 90 crores in terms of the bank. The amount of trade receivable gets a credit, which is equal to the book value 95 crores. And there is a balancing figure 5 crores, which is going to be taken in the profit and loss. That is a loss on a derecognition. So I'm putting the same entry which you put in terms of a complete derecognition. That is, a bank gets a debit for the consideration received. The trade receivable gets a credit at a book value, and there is a loss. Now see, can you see in the entry cash is debited at 90? Can you see the loss on derecognition is given a debit at 5? And can you see the receivables is given a credit to the extent of 95? This is one portion of the entry. But I am now responsible in terms of a guarantee to bear an amount of 5 crores. And since I've given a guarantee, this financial guarantee is also to be accounted for at a fair value. I hope you got my point. I would just like to take you back on this and see the inputs out here. So if you just have a look at the illustration 12A, it says the guarantee is estimated to be value of 0.5 crores. So there are two things which you need to consider now. One is your involvement to the extent of bearing that 5 crores. That 5 crores which is expected bad debt is already been written off and a provision has been created. So now the liability of this company, which is going to the factoring agency, his liability is limited to the extent of 5 crores. So see what is the entry which you will pass at this stage. So what we're doing, we are creating a continuing involvement asset to the extent of 5 crores plus the financial guarantee. And we're also creating an associated liability to the extent of 5 crores plus that 0.5 crores financial guarantee. So you can see that once you pass, if you just forget about the financial guarantee for the moment, what you're doing, CIA, continuing involvement asset debit, associated liability credit, and this entry is done with 5 crores. So can you see that you did the complete derecognition, but then you stand up recognizing another asset and another liability. So you can say that there has been a partial derecognition of an asset, a derecognition of 95 and then a recognition of 5. So it's a partial derecognition and with associated liabilities as well. And since we also need to account for the financial guarantee, so this amount is being included in the amount of the involvement asset. I hope I am clear with the picture. So now you need to see the model of the story. I'm now going to answer the question what I think Shruti you asked me, and I said I'm going to answer your question in almost the next 1 hour. And now it's time that I answer your question. So let me do one thing. Let me just answer your question at this stage. And this analysis you will now wonderfully analyze and understand. So there are a total of 3 principles we can see. Let's imagine the T-shaped balance sheet, and let's give you the 3 inputs to understand the essence of the derecognition principles as well. So let's consider that this is a balance sheet. Let's consider this is a balance sheet, and this is a balance sheet. Let's consider a T-shaped balance sheet for a little understanding, and let's take 3 cases. Let's consider the 3 cases. Let's consider this is a case of a full derecognition, and this is a case of, let's say, no derecognition. That means you continue the asset, and let's say this is a case of a partial derecognition. So these are the 3 permutations combination. Now, let's consider one thing. You see, you need to first understand that why is a company going to a factoring agency? Can I say in order to basically increase its liquidity? The idea of approaching a factoring agency is that I know my debtors are going to pay me in a certain period of time because I allowed them a credit period. But in any case, what I am planning that I allowed them a credit period, but I need to receive more money because I'm in need of liquidity. So in this particular case, let's say your existing trade receivable is appearing to the extent of 95 crores. Let's say your trade receivable is appearing at 95 crores. You met the parameters of a complete derecognition. So what are you going to do in terms of complete derecognition? You will remove this money and you will insert that you got 90 crores and you are going to take a hit in the other equity, that is 5 crores. So can I say in this particular case, it is a derecognition which is complete. So what I did, one financial asset gone, another financial asset came. So it's an exchange in terms of one financial asset for another, but at a loss. And that enters my P&L, that affects my other equity. So you organized a liquidity at a cost of, you organized a liquidity at a cost of 5 crores in this case. Let's look at the other situation. You got a trade receivable, which is 95 crores, same example. But in this particular case, let's say it is a no derecognition. So what do? You put the entry bank account debit, that is 90 crores. And you also record a financial liability to the extent of 90 crores. Can you see in this particular case, the liquidity is achieved and you are indirectly considering that you've taken a bank loan. Now you need to typically look at this particular situation and you would notice that, a company could traditionally increase a liquidity. A company could traditionally increase a liquidity by taking a loan of 90 crores. The company could have taken a loan. You are in need of liquidity. You go for a loan of 90 crores and you'll end up creating a loan in the balance sheet. Now, trust me, many a times what the companies would do in a practical life situation, which we need to be careful on, they needed money and they knew that if they're going to borrow the money, it's going to create a debt in the company, which is going to disturb your debt equity ratio, which is going to massively affect your interest coverage ratio and other implications as well. It would impact your current ratios, your quick ratios, your liquidity ratios. It could impact in terms of a debt equity ratios, etc. So what the company plans out that if some way I can prove that it is a case of a complete derecognition, I will be able to save my debt equity ratio. So do you think if the companies would manipulate and enter into arrangements and they want to avoid a financial liability, I will say, boss, there are principles to decide a derecognition. You cannot enter into arrangements and derecognize your financial assets. I'm going to look at the larger picture. I'm going to look at the substance of the legal form and decide that the kind of arrangement you entered into was actually a loan in nature or was it a case of a derecognition? Are you getting the point? So since the industry could have manipulated and they could have entered into arrangements for getting liquidity, they could have entered into arrangements in terms of getting liquidity and at the same time trying to window dress the balance sheet. A loan, a so-called loan, is organized in such a way that you land up derecognizing. So the companies could traditionally organize loan, but they don't want to organize a loan and they go for arrangements and try to manipulate that it is a case of derecognition of asset. You might be trying to manipulate the picture. So keeping the interest of the stakeholders at large, I need to tell them, boss, that you can enter into any kind of complex arrangements. Remember the essence is what I've always said in terms of financial instruments, you can never stop companies from entering into arrangements. You can never stop people from entering into complex kind of arrangements. So what is the need is to see what is the essence of the arrangement. If you take money from a debtor and you say, oh, I took money from the factoring agency, let me remove my assets and put the bank balance, I'm improving my liquidity and I'm improving my debt equity ratios and my liquidity ratios at the same time. Whereas technically, that's not the case. If you're discounting a bill of exchange, you know that you're discounting a bill of exchange, but then do you think you can actually consider that to be a derecognition? No. So the larger picture is that the company enters into a transaction. You need to see that is it in substance actually a derecognition, or in substance actually a loan, or maybe it's a blend of a loan and a derecognition. Let's have a look at the third situation and then let's get input further. So let's take the case that there is a trade receivable to the extent of 95 crores. And in this particular case, I received a money. So what I did, bank account 90 crores is recorded. So what we did in this particular case, we said, let's derecognize. But we had a continuing involvement asset to the extent of 5 crores. And I also created an associated liability to the extent of 5 crores as well. So can you see that it's a derecognition, but still resulting in a change of a continuing involvement? So there is a change in terms of the asset. There is a change in terms of the asset, but there is an impact of a debt on the company. Now you need to appreciate one thing. When it is a complete derecognition, there is no debt burden on the company. If you look at no derecognition, there is going to be a full debt burden on the company. Because this is in substance not a loan, this is in substance a full loan. And in this particular case, we can say it is creating a partial debt burden on the company, and that is 5 crores. So this is one extreme, that is another extreme, and that's a mid situation. So the concept of derecognition of the financial asset is linked to the concept that in substance, are you entering into a loan arrangement, or in substance, are you actually, derecognizing your assets? So when it is a complete derecognition, it doesn't lead to any kind of debt burdens on the company, no debt equity ratio impacts. If you're entering into an arrangement like this, it's a debt equity ratio going to change, because in substance, it's a loan. And in this case, it is a debt equity change, but very nominal change, because it is a case of a partial derecognition. I think, Shruti, your question would have got appropriately answered. I think so. Right? Okay. And Shruti, you said, sir, instead of this bank debit to associated liability, nahi hona chahiye tha. Bank debit to associated liability? No. You see, I have split the entries in terms of two components. The bank is for the derecognition of the asset, and the rest is a contra entry. If you actually notice, the continuing involvement asset in the associated liability is just a contra entry, so that your debt equity ratio changes because of the associated liability in the books of accounts. Okay, and you said, sir, as you said, it will be treated as a security to bank debit to financial liability instead of financial asset debit to FL. Now, I think your answers would have got clear now. Just let me know, with this entire picture in terms of full, no, and partial derecognition, I think, does your question get answered? Why the principles of derecognition is being applied? Because we need to look at the essence of the arrangement you enter into, the complexities of arrangement you enter into with the other people. I can't stop you from entering the arrangements, but I need to apply microscopic eyes to evaluate, is your arrangement not a loan? Is it a loan, or is it a case of a partial loan? And that's how the accounting treatment is done. Right, I hope I am pretty clear. Your question gets answered. Do let me know if your questions are answered. I think now, before we go to the PTA, I have given you all the treatments, and in this case, I am now going to quickly make a summary chart and get ready for your comfort zones on that. Yes, clear, Shruti, that's great. So I'm going to make a quick chart on the derecognition accounting, and get ready for your scores on a scale of 10. PTA is pending, that we'll take up, that's not an issue, but get ready for your scores. So I am now going to consider a small little mind map in terms of the journal entry. And after this, tell me, what is your comfort zone on a scale of 10 on the derecognition principle, the three-step model, and the accounting treatment in terms of different kinds of derecognition? So let's summarize the accounting treatment. Let's summarize the accounting treatment in terms of derecognition of financial assets. So we're looking at the derecognition of financial assets. What are the various permutations, combinations in terms of derecognition? So I'm going to first of all divide this input in terms of three parts. So I can say one is a case where there is a full derecognition, and one is a case where there is no derecognition, and one is a case which is a case of a partial derecognition. And I would also put it like this, that a case of full derecognitions is possible in different combinations, like for example, cash flows expired. And at this stage, I like to remind you something more in this entry. So when you say it's a full derecognition, the entry is bank account debit. This is with the consideration received. And the financial asset gets a credit, and this is with the book value of the financial asset. Now, let me remind you, when we were discussing the accounting treatment of financial assets, we already discussed the profit or loss on sale, but I think it's now time to remind you the inputs as well. Can I say the profit loss on derecognition? Whatever is the profit or loss on derecognition would depend upon whether the financial asset is at AC or is it measured at FPT OCI, that is NR or R, or it is measured at FPTPL. Oh my God. You need to get the larger picture as well, that when there is a complete derecognition, the profit or loss on derecognition is going to enter the P&L OCI, and what is going to happen to the accumulated OC. So let's have a look now out here. So we can say that if it is a case of AC, I'll take the profit and loss to the P&L. If it is a case of OCI NR, I'm going to take the profit or loss in OCI. Remember that if it is a case of equity investments and the investments is sold, the profit loss is entered in the OCI, never in the P&L. And in this particular case, the accumulated OCI, which is there in terms of tab number 3, is going to be transferred, can I say, to the tab number 2 directly, that is in the retained earnings. Oh, wow. So this is what we have already done earlier as well, that the accumulated OCI balances is going to be shifted from the tab 3 to the tab 2 in the RE column. If it is a case of recycling, then I'm going to transfer. Then I'm going to transfer this money to the profit and loss account, and the accumulated OCI balance, which is there in terms of tab number 3, is going to be indirectly transferred to the tab number 2. You're going to put it in the profit and loss. So this accumulated balances will be transferred to the profit and loss account in the year of derecognitions. And finally, if it is a case of FPTPL, you're going to put this in the P&L. So I think that discussion also required a mapping. So any gain or loss on a derecognition is going to be taken to the P&L or OCI depending upon the category. And you need to see what is the treatment of that accumulated OCI as well. Now let's have a look in terms of the next agenda, that if there is no derecognition, you're going to put the entry bank account debit. This is with the bank account debit and financial liability credit, and this is going to be with the fair value, which is the consideration received minus the TC, and then subsequently, this liability is going to be measured at AC, amortized cost, using EIR. This is going to be accounted subsequently in terms of amortized cost using effective interest rate. Though we have not seen any illustration on this area, but I think theoretically, at least I can tell you the entry. Then comes the area when it is a partial derecognition, then it's a blend. So what I'm going to do, I'm going to put the entry that is bank account gets a debit, and the bank gets a debit to the extent of the consideration received. The financial asset is going to get a credit, which is to the extent of the book value of this asset. And trust me, even in this case, the gain or loss, even the gain or loss in this case is going to be again dependent upon the category of financial assets, as we have discussed here. So the gain or loss is going to be taken at which place will depend upon the category of financial asset. Is it AC, OCI, RNR, or is it a case of FPTPL? And along with this entry, you also need to put an entry continuing involvement asset debit. I'm putting it a CIA. That's a continuing involvement asset debit, and AL, that is an associated liability. And this amount is something which is going to be given in the question itself. Or I can say this is equal to the amount of financial guarantee plus the fair value of the financial guarantee. It is going to be equal to the fair value of the guarantee, that was 0.5 crores, and the amount of guarantee given, that is 5 crores. So a contra entry in terms of CIA, continuing involvement asset and associated liability, gets recorded. So this is the mapping in terms of the accounting treatments for full, no, and a partial derecognition. The principles done, the accounting done, the mappings done. I think it's now time to get some inputs on your comfort zones on this area. Let's get this. Okay, 9 out of 10, that's what Yedu tells me. That's great, superb indeed. And full recognition creates other equity. Yes, you can say that. A full derecognition would hit your other equity in terms of, any gain or loss which arises on a derecognition. Other equity is going to hit in terms of a partial and a full derecognition both. Except that in terms of no derecognition, there is going to be no hit in terms of other equity. Okay, I think Shruti sends me a score of 8. Let's get some more scores, friends, on your comfort zones on this. I think that was a very technical area. I am pretty sure you must have found it technical, but I think now the picture would be a little more clear. Once you revise this in the entire go, you will say, wow, the derecognition is not too hard in nature. Now, we've done everything in terms of derecognition, but a PTA is pending. So we're going to discuss PTA. I think my timing factor was quite perfect indeed. I said almost by 7:30, you will be able to get an entire picture in terms of things. And we got another score, 8 and 8. And that's wonderful indeed. I think that's good to go. That's good to go. Okay, now I think let's discuss the last aspect in terms of the cash flow test, that is a PTA, a pass-through arrangement. Let's have a look on that. So I'm going to go back and now go back to the study material. And there is a concept of a PTA which is given. So let's discuss the concept of a PTA. Let's have a look at the pass-through arrangement. This is an illustration number 6. And in terms of illustration number 6, we are given the inputs in terms of what is a case of a PDA. Now, this is again very interesting indeed. And you know what a PDA is going to be? It's something which we can say is something like a debt securitization process. In simple words, we can say it's more like a debt securitization process. So we need to understand this illustration. Once we have understood this illustration, you'll be able to get the parameters in terms of PDA. And interestingly, you'll again see the number 3 coming in. In terms of a pass-through arrangement, there are 3 conditions. If those 3 conditions are met, it becomes a case of a PDA. So again 3, yes, again 3. Let's read illustration number 6. So this is a case of a PTA that's called a pass-through arrangement. It says A makes a 5-year interest. I think let's do one thing before I read this illustration. Let's create a mapping in your mind. So you're able to visualize in terms of what happens in this. Okay, Prashant, you said, so in no derecognition, is it necessary that consideration received will be equal to the fair value? Now, that's an interesting question again, that the consideration received is equal to the fair value or not. Well, I guess, at least from the examination point of view, I'm going to assume that the amount received is equal to the fair value itself. Otherwise, the triggering thoughts would arise. What do you do with the difference between the transaction value and the fair value? That's going to be dangerous indeed. I remember somebody asking me last time, so what is the subsequent accounting treatment in terms of CIA and associated liability? Well, we are not discussing all that. There is no dearth in terms of getting into research. The study has only given you the inputs in terms of the entries at the time of partial derecognition. How does the continuing involvement asset, how does the associated liability is accounted subsequently is not given. IFRS Ind AS is based on IFRS, and trust me, it is just a guidance. Ind AS is not something which you can say is a complete picture in itself. In any given situation, the standard only tells you, what is done in a basic situation. If the complexities arises, judgment is done. And therefore, we say accounting is an art. And when we say accounting is an art, that indicates it is supposed to be a complete judgment. Okay. Now let's come to the concept of a PTA, that is a pass-through arrangement. So let me take a little example to explain how does a PTA exactly work before we come back to the illustration. Now let's consider a case. I am considering, let's say, 3 boxes out here. I'll tell you what I am explaining. So let's consider 3 boxes and let's have a look in terms of what is going to happen in this particular case. Let's say there is a company XYZ Limited and it creates a trust. And there are certain investors in the market. Now see what happens in a PTA. As you can see, it's a pass-through arrangement and it's through a trust. Now what company XYZ Limited does, it basically pools its financial assets. I guess you remember when you did your financial management in terms of intermediate, you understood the concept of what is called a debt securitization. So what the companies do in a debt securitization, they've got a huge pool of financial assets with them and they're wanting a liquidity. And what they do, they pool their entire financial assets. So what this company would do, they pool the financial assets and they transfer the pool of assets to the trust. Now, what the trust does, it approaches the unrelated investors. It approaches in the market unrelated investors and it issues securities. It issues securities to them. So they will approach the unrelated investors and tell them that, okay, I'm going to issue securities. Will you purchase the security? Now, why would an unrelated investor actually go in for a trust? Why would he say that I'm going to buy things from you? So the trust will actually tell them that at the back of me is a company XYZ. They pool their financial assets. So what I will do, any money which comes from these financial assets, I will pass it on to you, to the investors in the form of returns. So basically, you give me the money by issue of security. I issue the securities and you give me money. He passes that money to XYZ. So you can say the trust is acting as an intermediary in the sense he issues the securities to the investors and takes the money and gives it to XYZ. In return, he passes on the cash flows. He passes on the cash flows of all these financial assets to the investors as and when they come, without any material delay. So the investors know that the money they are pumping in terms of security is in lieu of the cash flows they are getting. Now you would say, so what is the need of getting into a trust? Why doesn't the investor directly approach the company XYZ? You're again forgetting maybe the basic rule that if the company XYZ approaches these investors, it is going to create a debt in my company. And I'm trying to create liquidity without creating a debt in the company. I'm wanting to create certain arrangements where I don't have to create a debt. Because if I'm going to directly deal with this investor directly in my balance sheet, I'm going to issue them securities and I'm going to create a financial liability in the books of accounts for the securities issued to them. So the liquidity will be created at the cost of creating a debt in my company. So what we do, we put a trust in between. Now you would say, sir, that means company XYZ is trying to manipulate the positions and he's trying to get the money from the investors and he's trying to do an arrangement where he's not required to, create a debt. Well, I would allow him not to create a debt if he's able to meet 3 conditions. If he's able to meet three conditions, then I would say yes, cash flows are transferred. The standard is said that for an arrangement to be called as a pass-through arrangement, for an arrangement to be called as a pass-through arrangement, there are three things which I need to achieve. Number one, we can say that XYZ will pass the cash flows without any material delay. He's going to pass on the cash flows without any material delay. There is no explanation given in the standard that what is a material delay, but they've said you need to pass on the cash flows without any material delay. As and when the loan holders of this company, so the debtors of the company pay the money, he's going to immediately pass on that money without any material delay. And he will pass on only what he gets, no penny extra. The second is that XYZ should not be in a position, he cannot pledge. He is not able to pledge these financial assets to anybody else. So we will tell him that, boss, if you're pooling these financial assets and passing the cash flows, you will not be able to pledge them any further. So pass on the cash flows without a material delay. You're not allowed to pledge these assets further. And then there is a third condition as well. And the third condition in this particular case is that he will transfer only what comes. I'm not responsible to pass on anything extra. So the basic thumb rule is I pass on what comes, I pass on without delay, and I can't pledge. So a pass-through arrangement means jab aaye, jitna aaye. Jitna aaye, utna de do, jab aaye, tab de do, or pledge mat karo. That's what I tell people, that pledge, that the pass-through arrangement is jab or jitna. Jitna aaya, utna diya, jab aaya, tab diya. And in this particular case, you cannot pledge. If you fulfill these parameters, it is called a PTA, a pass-through arrangement. Let's, I think, come back. Let's have a look further in terms of this. Shruti, so what is your favorite number, by the way? Well, 3 is not a favorite number. I've just created a 3-step model. That's not a favorite number. No favorites as such. Let's come back and let's have a look in terms of the illustration 6 back again. It says entity A makes a 5-year interest-bearing loan of 100 crores to B. So entity A made a loan to B, which means they created a financial asset with them. Company A gave a loan to the company B. So company B is taking a loan from A. So it's creating a FA for A. Entity A settles, that means creates a trust and transfers the loan to that trust. It pools the financial asset, transfers the loan to the trust. The trust is going to issue participatory notes to an investor, entity C, who is going to be unrelated, and it entitles the investor to the cash flows on the asset. The very first para is telling you the entire detail. Entity A created a trust and passed on the cash flows of the FA. And the trust is going to issue security and take the money from C. So money taken from C given back to A. And the cash flows coming from A, from the company B, transferred to C. As per the trust agreements with entity C, in exchange for a cash payment of 90 crores, the trust will pass to entity C 90% of all the principal and interest payment collected, as and when and if collected. It says as and when, which means without any delay. If collected, I'll pass on what is collected. Jitna aaya, utna diya, jab aaya, tab diya. The trust is accepting no obligation to make any payments to C. I'm not going to give anything extra other than that 90% of exactly what has been received. The trust gives no guarantee to C about the performance of the loan, no rights to retain 90% of the cash collected from B, nor any obligations to pay C if they have not received the money. Compute the amount to be de-recognized. I guess in this particular case, if I apply my 3-step model, let's have a look in terms of how my 3-step models is going to apply in this particular case. So let's go to the 3-step model in terms of de-recognition. We go to the step number 1 and look at the cash flow. Have the cash flows expired? No. Have the cash flows been transferred? No. Is it a case of PTA? Yes. It is undoubtedly a case of PTA with the three conditions met. Well, the three conditions met, you're going to pass on the cash flows as and when received. You're going to pass it on whatever comes, you're going to pass it on. You cannot pledge. Though it was not given, I assume that the entity A cannot pledge. Then if the cash flows, it is a case of PTA, I go to the step number 2 and I look at the risk and reward. Now you need to understand one thing. Entity A is telling the trust and the trust is indirectly telling the entity C, जितना आएगा उतना दूंगा, जब आएगा उतना दूंगा, कोई गारंटी नहीं मेरी, और नहीं आया तो नहीं दूंगा. So what do you think? The risk and reward is being substantially transferred or not? I think yes. In this particular case, when it clearly says the trust is providing no guarantee about the performance, no rights to retain from B, nor any obligation to pay C if the cash is not received. He says, what will come, I'll give you. What doesn't come, your problem. I'll give the entire money. What comes, I'm not responsible. So it is as good as a non-recourse arrangement. And if it is a non-recourse arrangement, I would say the risk and reward is substantially transferred. If it is substantially transferred, it is a case of a complete 100% de-recognition. It is a case of, you can say, 100% de-recognition. So what is the entry you're going to pass in this particular case? See, it says very clearly back out here, if the three conditions are met. I've already told you what are the three conditions. You are going to pass on the cash flows when they arise. You will pass on only what arises and you cannot pledge. So if the three conditions are met, the proportion sold is de-recognized, provided the entity transferred substantially all the risk and reward. And I think in this case, the risk and reward is definitely transferred. Thus, entity A would report a loan asset of 10 crores and de-recognize 90 crores. So in this particular case, you will go in for a de-recognition of that 90% of the principal and interest rights which you've transferred. That was the case of PTA. I hope, friends, I am pretty clear now on the concept of a PTA as well. Okay, I think Prashant, you said who cannot pledge? It is the entity A, which is the originator. He cannot pledge. So in this particular example, we are saying that entity A, who's got that financial asset, cannot pledge it further. So if you're entering into an arrangement of a pass-through, entity A cannot pledge these financial assets with anybody else because he's passing on the cash flows to the trust and through the trust to the investors. And number two, he has to pass on the cash flows as and when they come, and that is without any delay, and he has to transfer only what comes. He's not responsible in terms of giving anything extra, no guarantees, nothing. Right, friends, so that is the inputs in terms of a de-recognition. My first area on a de-recognition is completely done. De-recognition of financial assets, the three tests, including the PDA, the accounting treatment, everything is done. Now we need to go to the next area of discussion, and that is a de-recognition of financial liability. So let me just give you a little brief before we take a break. And before we go on to the discussions in terms of de-recognition of financial liabilities, so let me, I think, just give you a quick brief first of all on this area. So now we are looking in terms of de-recognition of financial liabilities. We're looking in terms of de-recognition of financial liabilities. Just to give you a little brief before we take a break, and then we go to see. In extended version, there have been questions which have come in the exams on de-recognition of financial liabilities. Yes, this is a little section which has come in the exams as well. Now, when you say de-recognition of financial liability, it again means that there is going to be a removal of the financial liability from the books of accounts. Now, let me tell you, the concentration, the area which we're going to concentrate in terms of de-recognition is, typically, we can say a concept called SDR. So when you're looking in terms of de-recognition, we're typically looking at the concept of what we call SDR. This is called strategic debt restructuring. It is called strategic debt restructuring. Now, what is a strategic debt restructuring? Let me explain this in simple words. You would have seen a lot of companies in practical life as well that they're taken loans from the banks, but they are not in a position to repay the principal or repay the interest on time. Not that they don't intend to pay not intend to pay the bankers, but they don't have the liquidity positions. So one is that you don't intend to pay, so it becomes a bad debt for the banker. Though I'm not looking at from the banker's point of view now, because we're focusing at a financial liability. So we're looking at from the point of view of the company which has taken a loan. So the company has taken a huge loan from the bankers, and in this particular case, their inability to pay, they request the banking companies that let's restructure the debt. And the restructuring is done in such a way that the bankers would say, okay, your money is due at this stage, let's defer, let's tell you that you're going to pay a little later. Let's increase maybe the rate of interest for a later period. And they're not saying that you don't pay, but they are saying that, okay, we will restructure the debt in such a way that we give you more relaxations to pay according to a certain time frame. Now, this SDR, that is a debt restructuring, which is a negotiation with the bankers, could result in, I'm saying could result in a derecognition of financial liability. And all this concept of derecognition depends upon a parameter which is called a 10% test. There is a concept of a 10% test which will decide the fate, whether a derecognition of the financial liabilities will take place or not. So if you meet a 10% test, what is the 10%? We'll see. But if you meet the 10% test, it leads to a derecognition, and that is called extinguishment accounting. And if you fail the 10% test, it does not lead to a derecognition, and that is called a modification accounting. So there are two kinds of accountings which will stem out of the 10% test. One is called an extinguishment accounting. One is called an extinguishment accounting, which would mean a derecognition of the liability. And the other one is called a modification accounting. Now, the area of what we need to understand is twofold. What is this 10% test? How is this 10% test applied? And we're able to conclude that whether extinguishment or a modification accounting would apply. And if these two accountings apply, how does an extinguishment and a modification accounting is accounted for? That's the next focus area of discussion with you. But I think first we need to give you a break, much needed, I guess. And then we'll start with a little fresh mind in terms of derecognitions of effort. Right, friends. So I think at this stage, let's give you a break. So I guess almost around 7:48. So 10, 12 minutes. So see you approximately around 8 o'clock back, and we'll start our discussions. Enjoy your break. Friends. So I hope you got a relaxed mind. So switch over in terms of derecognition of financial liabilities with you now. And just to give you a brief once again on that 10% test, what we were talking of, let's, I think, just consolidate the journey and take it forward. So as I said, when you're looking at a derecognition of financial liability, it means that there is a removal of the balance sheet, the liability from the balance sheet of the company. And our focus in terms of derecognition is going to be typically on one situation, and that is called a SDR, that is a strategic debt restructuring. The companies might be unable to pay loans to the bank, and they would request the bank that let's restructure the debt, give us more time to pay, and the bank would change the terms. It would modify the terms and you can say conditions of the loan. And we need to see what is the extent to which the terms and conditions have been modified. Now, depending upon a test which is called a 10% test, that would decide the level of modifications. And once you decide that the level of modifications is, great, that means you pass a 10% test. You see that the modifications to the term done is, almost more than 10%. Then we apply an accounting called extinguishment accounting. The extinguishment accounting means that there is going to be a removal of the liability from the books of accounts, and it would lead to a creation of a new liability. But if you fail a 10% test, then we apply the concept of a modification accounting, which would mean liability is not going to be removed from the books of accounts. Now, my main focus of discussion is what is this 10% test? How is this 10% test conducted so we can conclude it is extinguishment or it is a modification accounting. Next stage is once you decide it is extinguishment, how does the accounting take place? And if you decide a modification, how does an accounting take place? So I think let's begin the journey. I am carrying the illustrations in the study material, which concentrates on the concept of derecognition of FL. So let me just bring you on the derecognition part. I'll explain this with a practical illustration to you. So let's have a look at an illustration. There is an example number 3, which is given on extinguishment accounting. So this is an example which is given on extinguishment accounting. I guess good to go, seems good to visualize. I'll explain these steps. Don't worry, the notes will come later. I'm going to first of all read the example, explain certain things, then we'll document the notes later in terms of what are the steps. So let's have a look at example 3, which is focusing on extinguishment accounting, but we need to make an assessment on the 10% test. So my focus is on the 10% test. It says on 1st January X0, the company XYZ issued a 10-year bond, which is bearing an interest rate of 10%, which is payable on December 31st each year. The bonds are redeemable on X9 for 10 lakh. So which means you issued the bonds on 1st January X0 and they're going to be redeemed at the end of December X9, which means there is a total 10-year span. There is no cost or fee which is incurred. If there is no cost, which means no TC, and there is no fees means there is no processing fee. So in this particular case, no TC and no processing fee would mean that in this case, the contracted rate and the effective interest rate should be same. Then he says the effective interest rate is therefore 10% for the reason that there is no TC, for the reason there is no processing fee. If you remember, in my earlier discussions, I had given you that there are 4 factors which could trigger the concept of an EIR. And that is, there is a discount on issue, there is a premium on redemption, there is a TC, or there is a processing fee. All these 4 factors could trigger the need of EIR. In this case, it's a bond which is issued at a face value, redeemable at a face value, no processing fee, no TC. So a perfect case where the EIR and the contracted rate is same. Then he says on 1st January X5, that is after 5 years, XYZ and the bondholders agreed to a modification. Now, don't consider that if it is a word modification, it indicates that there is going to be a modification accounting. This is only the English word which is telling that there has been some modification in the terms and condition. The term is extended up to December Y1. Now, when I say December Y1, be a little careful with the dates. The loan was originally supposed to be redeemed at the end of X9. Now it's going to be redeemed at the end of Y1. So we can say after X9 is going to be X10 and after X10 is going to be Y1. So you can say the extension is for a period of another 2 years. We need to be careful with the dates. The original redemption is X9 and it is extended up to Y1. So X9 to X10 and then X10 to Y1. Then he says interest payments are reduced to 5% from a 10% rate of interest and the bonds are redeemable at the end of Y1 for 15 lakhs. So there has been a restructuring. The two parties agreed that we will extend by 2 years, will reduce the interest rate to accommodate you, and the redemption is at 15 lakh. And there is a legal and other fees of 1 lakh which is incurred. Then he says XYZ determines the market rate of interest on 1st January, that is on the date of modification of the terms, on borrowings on similar rate is at the rate of 11%. So which means that if you consider a new EIR on the date when the terms are modified, it is supposed to be at the rate of 11%. Now, let's get a focus very clear. We are right now focusing on the 10% test. How do you decide whether we need to apply a modification or an extinguishment accounting? So the standard says apply a 10% test. And to make life simple, I'm going to convert this into, again, a 3-step model. So many 3-step models done in financial instrument standard. You actually need to start, looking at registers where all the 3-step models are there. So we're going to look at the 10% test and we're going to start with the step number 1. Now, in step number 1, what we need to do, we need to consider the present value of the remaining cash flows based on original term. So what we need to do, we need to calculate the present value of the remaining cash flows. So whatever is the present value of the remaining cash flows, we need that, but this is all based on the original terms itself. So I want to see what is the original terms. And I want to see that, okay, what is the present value of all the future outflows which were originally decided? Now, I'm going to use basic common sense and a basic financial management. I think I am looking at one thing, that if there is a bond which is a loan which is 10 lakh and you're going to pay a 10% interest every year, and you're going to repay the 10 lakh principal money at the end of each year, I think the present value of remaining cash flows will always be equal to 10 lakh. Because if you're going to consider that the interest is paid at the rate of 10% and you're going to discount it back at 10%, you reach the same figure. But just in case, if you got apprehensions, I would say, please calculate this. Now, another important thing, what you need to consider in terms of step number 1 is when you consider the present value, the present value is going to be taken on the basis of original EIR itself. The 10% test is all going to be based on the original effective interest rate itself. So whatever was the EIR of the original loan, we're going to consider the present value on those terms. So to be on a safe side, let's calculate. Can I say the modification is done after 5 years? So we can say that there is a payment for another 5 years pending. So we can say we will pay 1 lakh rupees interest at the end of each year, and there is going to be a repayment of 10 lakhs at the end of 5th year. So we need a PVIFA for a period of 5 years at 10%. I think that is 3.791 if my financial management goes good. And I guess the last year, 5th year factor is going to be 0.621. So we take the present value of all the remaining cash flows, and this is to be discounted using original EIR. So let's see what is the present value. So 3.791 and 6.21, and that gives me a perfect 10 lakh. And as I said, you don't need to really compute this. If you simply apply the logic that you're going to pay 10% and you're going to discount at 10%. So if you're going to compound at 10 and then discount at 10, you're 100% going to achieve the figure of 10 lakh itself. But to be on a very safe side, let's calculate the present value. This is step number one, and then you need to go to the step number two. Then you need to go to the step number two, and we need to look. Don't worry on the logics. I'll explain the logic as well, that what exactly are we trying to look into this step three-step model. So what we'll do, we'll take the present value of the new cash flows. So we will consider the present value of the new cash flows, which are based on the new terms, the modified terms. So just like in step number one, we've taken the present value of the original cash flow on the original terms. We're going to consider now the present value of the modified, the new cash flows based on the new terms. And when you're going to consider the present value, this present value will also be taken at the original EIR itself. To keep it mathematically same, we're going to consider the present value of the remaining cash flows using original EIR. We're going to consider the present value of the modified cash flows considering the same discounting rate itself. Now let's see what is the new figures which are available. The interest payment is now reduced at 5%, which means now I'm going to pay 50,000 interest, and this is going to be paid now for the remaining 7 years. Because the redemption got extended at December Y1, so remaining 5 years were there and another 2 years extended. So we need to consider a discounting at 10% for a period of 7 years. And then at the end of 7th year, the repayment is going to be 15 lakhs. So we need the discounting at the rate of 10% at the end of the 7th year. So let's see, at 10%, this is 1, twice, thrice, 4, 5, 6, and 7. The seventh factor, I think, is 0.513. And if you take the cumulative factor, let me still do it. 1, 2 times, 3, 4, 5, 6, 7. And this comes to 4.868. This comes to 4.868. And when you're calculating the step number 2, you need to consider another thing as well. In this entire restructuring, you're also going to pay another 1 lakh rupees at time 0. So your new terms are that if you're entering into the new terms, you're going to pay some money, TC, right now. You're going to pay the interest payment for the next 7 years, and you're also going to make a payment of 15 lakhs at the end of 7 years. So we're also going to add another 1 lakh, which is the transaction cost paid at time 0. So let's see what is the present value of all the new cash flows at original EIR. So 50,000 into 4.868, 243,400 plus 1 lakh, and this is 343,400. 343,400, and I guess this is coming to a total of 11 lakh 12,900. So this is coming to 11 lakh 12,900. This is the present value. Now the step number 1 is done and the step number 2 is done. Now what we need to do, we need to compare the two. So we're going to go to the step number 3. So now we're going to go to the step number 3, and in terms of step number 3, you need to calculate the percentage change from step number 1 to step number 2. And basically now you can see what we're trying to do. We are basically trying to calculate that what is the variation in terms of the negotiation. The 10% test is telling us that, if the variation is more than 10, it's time to remove the old liability and recognize the new liability. But the variation is restricted in this particular case. If the variation is restricted in this particular case within a parameters of 10%, then you can continue the old liability. So the 10% test is like, you can say, a materiality test. Remember, when you do a materiality test as well, you always look at that if the change is beyond a 10%, it's a material change. And if it is less than 10%, it's not a material change. So the standard setters decided that if there is going to be a debt restructuring, you need to see that, the change is more than 10% or not. So you can say this is 10 lakh and this is 11 lakh 12. So what is the change? The change is 11 lakh 12,900 compared to 10 lakh rupees over the base of 10 lakh rupee. And we're going to calculate this as a percentage and see what is this percentage? What is the variation? And now you can see that in terms of the variations, you are considering the same discounting rate itself. So that you are only looking at the cash flows patterns which have undergone a change. If the discounting rate is the same, it is only the present value is only affecting when is the timing factor of the cash flows taking place. So the variations in this case turns out to be 11 lakh 12,900 minus 10 lakh divided by 10 lakhs. And this comes to 11.29%. So this is the variation change. I guess my percentage might be slightly different. If you look at the study, it says 11.32%, but I've got 11.29, which is as good as 11.32. Your PVIF factors could slightly make a change. Now, once you conclude that there is 11.29% change, it means that in this case, you need to remove the existing liability and the case of extinguishment accounting would apply. So this would give us a conclusion that extinguishment accounting would apply. So let me remind you, I am yet to do the extinguishment accounting. We have only applied a 10% test to decide what kind of accounting would be triggering. So in step number 1, you took the remaining cash flows based on the original terms at original AIR. Then you took the present value of the new cash flows discounted again at the original AIR. You took the percentage change if it goes beyond 10, extinguishment accounting 10 or more than 10. 10 or more than 10, it's extinguishment. And if it is less than 10, then a modification accounting would apply. Now the question rises, how would the extinguishment accounting be done? I hope I am pretty clear so far at this stage. Now, let's go to the extinguishment accounting. So once you've decided that yes, an extinguishment accounting is going to apply, let us see how the extinguishment accounting would apply. How the extinguishment accounting in this particular case would apply. So when you're going to look at the extinguishment accounting, it's time to create a new financial liability and remove the existing financial liability. So let me put it like this. I will put in the brackets old, the financial liability, old one is going to be derecognized, and the financial liability, which is the new one, is going to be given a credit, and any difference in this entry is going to be called as a gain or loss, which is arising on a derecognition, which is going to be taken in the P&L. Now, the derecognition of the old liability undoubtedly is going to be at the book value, which is appearing at 10 lakh. And if you look at the financial liability, this is going to be taken at a fair value. This is going to be taken at a fair value. Now, watch it carefully. When you recognize a financial liability, it is taken at a fair value minus a TC. Initially, when you consider an initial recognition of a financial liability, it is always taken at a fair value minus the TC. But in this case, the variations in the terms have been such that there is more than 10% variations in the terms. So the standard says, boss, now you're going to recognize the financial liability at a fair value, and this concept cannot apply. You cannot take the TC and the TC is going to be immediately expensed off. So, but why? First of all, you're not paying the money of the other fellow, and then you want to get a deferment of the TC? Of course, not allowed. Originally, when you took that amount of financial liability, your reduction in the TC resulted in triggering an EIR, and you were able to get a deferment of a TC. This time, the company is being indirectly penalized as well, and we're telling him that, boss, you're restructuring the debt, you're a bad company, and you're trying to restructure the debt. So you're going to recognize this at a fair value, and the TC is going to be immediately expensed off. So, moral of the story: when you were looking at that 10% test, I took that TC into account because I wanted to check the variations in the cash flow. Mind it, when I took the 10% test, I took the TC into account because we want to look at the variations in the cash flow. But when it came to recognition of the new financial liability, the TC is nowhere going to play in this. So when you go to consider a fair value, what do you consider the fair value to be? The fair value is the present value of all the future cash flows based on the new terms discounted at the new EIR. You heard me correct. Not at the original, but at the new EIR. So in this case, you're going to consider the present value of the future cash flows. And this is the future cash flows based on the new terms. It is the present value of the future cash flows, which is based on the new terms, and the present value is going to be taken based on the new effective interest rate as well. So the crucial points is to remember, when you go to consider a new financial liability, what is the value at which it is to be taken. So in this particular case, when you're going to consider the present value based on new effective interest rate on the new cash flows. So I think we already know what is the new cash flows. The new cash flows is 50,000, and this is going to be paid for the next 7 years. But this is going to be discounted back at the rate of interest, which is 11%. The company determines on January X5, on the date of modification, that a similar loan is available at 11%. So we're going to do the discounting at the rate of 11% for 7 years. And you're also going to pay 15 lakhs at the end of the 7th year. So let's see the PVIF. So at 11%, 1 divided by 1.11, once, twice, thrice, 4, 5, 6, and 7. So the 7th year factor is 0.482, 11% for a period of 7 years. And if you take the cumulative, it is 4.712. So this is going to give me what is the present value of the new cash flows based on the new terms at the new EIR. So this is going to be 4.712 into 50,000, 235,600. So 235,600, this is coming to 958,600. So this is coming to 958,600. That is the present value of this. And of course, we'll take care of that 1 lakh separately paid as well. So maybe if you want to merge it in this entry, you can. Then you're making a payment of 1 lakh, which is the transaction fee. So now we can see the balancing figure. That is going to be the gain or loss taken in the P&L. So let's see the balancing figure. What is the balancing figure in this entry? So 958,600 plus another 1 lakh and minus the 10 lakh. I guess we're getting a balancing figure on the debit side. 58,600 is the amount which is debited to the P&L. This is supposed to be the loss which is arising on a derecognition of the FF. Wow. So we've seen how the 10% test is conducted with a 3-step model, and then once you decide it is extinguishment accounting, you derecognize the existing liability at a book value, 1. You recognize the new liability at a fair value, which is based on the present value, using the new EIR and the new terms, and whatever transaction cost is paid is also recorded in the bank, and the balancing figure enters in the P&L. I hope, friends, I am pretty clear on the derecognition of this. Prashant, so why 1 lakh is added in the 10% test? Okay, I think I mentioned that. Let me explain that once again. You see, when you're conducting the 10% test, what is the basic logic? The basic logic is, first of all, you're using a common 10% rate to discount the original cash flows and the new cash flow. Now, when you use a common discounting rate, so which means the present value will change only because of the timing factor of the cash flow, right? So because if you're taking step number one, if you're taking the step number one based on 10% and the step number two also on 10%, so basically when you compute things at a 10% rate, it is only the timing factor of the cash flows which will, decide the fate of the present value. So they decided that we want to look at the variations due to negotiations. So when you're looking at the variations due to negotiations, I would consider entire outflows. I'll consider entire outflows including TC. Because this modification led to, a changes in terms of what you were supposed to pay and what you're now supposed to pay. And if this modification results in a more than 10%, and we are saying that now it's time, you please remove the existing liability and create a new liability. And at the same time, when you decide that, I think the standard setters had something very logical in mind. The concept of reducing the TC from FL is a benefit to the company. Because when you reduce the TC from the FL, it gives you a deferment advantage. And in this case, I wanted to penalize the company that you are doing a debt restructuring, which is, making the bank tell you that your variations is going to be more than 10%. A variation in more than 10% means that you must be in a real bad defaulter, right? And if you've been a real bad defaulter, that's why the arrangement is, asking you to pay more than 10%. So in this particular case, they decided we'll not give you the benefit of TC, unlike what we gave you at the time of initial recognition. So the deferment of TC was allowed at that time. Now the benefit doesn't come. So every amount of TC paid at time zero hits your profit and loss account. Right? I guess you get your answer on that, I believe. Okay, so I think let me just quickly walk through the answer. So I think I'm just going to show you the entry. So let me just have a look at this. We're getting a loss of how much? 58,600, almost similar, because I've taken a slightly different, sometimes decimals could make a difference. So I'm not taking you on the solution. I've already done the solution. I just want to show you the inputs in terms of things. See what is stated in terms of the treatment. There is a gain or loss, and the gain or loss is 10 lakh is the existing liability, 958,097. 958,097, slight little difference due to discounting, and this 1 lakh. So we're getting a loss of 58,097. I've given you the journal entry to understand the difference, right? So this is as far as extinguishment accounting is concerned, right? I guess, Prashant, you got your answer. I guess, hope so on that. Now let's, I think, take it further. Let's now take it further. And I'm now going to take you to another illustration where we're going to see that the 10% test is going to fail, and that is going to lead to what we call a modification accounting. So let's have a look at another question with you. So there is an example number 4, which is quite similar. There is an example number 4, which is quite similar. And in this case, again, we're going to apply a 10% test. We're going to apply a 10% step with a 3-step model and then see that if it fails, then how does a modification accounting take place? So let's have a look in terms of the 10% test to begin with. Clear? Wonderful indeed. So let me read. It says, on 1st January X0, XYZ issues a 10-year bond, which is bearing an interest rate of 10%, payable at the end of each year. The bonds are redeemable on December X9, same input. There is no cost, there is no fees incurred. So which means no discount on issue, no premium on redemption, no TC, no processing fee, which means contracted rate and the effective rate is same. The effective rate of interest is 10%. Then he says on 1st January X5, that is after 5 years, the XYZ company and the bondholders agree to a modification. And it says no further payments are made. The bonds are going to be redeemed at the original date on December X9, but at 16 lakhs. And the fees which is paid with the borrower is 50,000. Slight little change in terms of the terms and conditions. Let's again look at the step number three. Three-step, decide a 10% test and decide the fate. So let's go to the three-step model to begin with. So we are applying a 10% test and we want to understand that what is the variation in terms of things. So we're going to first apply the step number one. You need to consider the present value of the remaining cash flow. So we need to consider the present value of remaining cash flows, and the present value of the remaining cash flows is going to be taken at what rate? Original EIR. So when you're going to consider the present value, we are going to consider the original effective interest rate. So in this particular case, I think I can directly pick this as 10 lakh this time, because in any case, this is same as example 3. I don't think so I need to prove that to you. Then we go to the step number 2. And in terms of step number 2, we're going to calculate the present value of the new cash flows. So we need to calculate the present value of the new cash flows. And this is going to be again at the original EIR itself. That is what you need to remember, that when you're conducting the 10% test, the focus is on the original EIR and the focus is on all the outflow, including the TC. So in this particular case, now we're going to consider what is the cash flows. No further payments of interest, only 16 lakhs is going to be paid at another 5th year end. The original money, the original due date is there. So you got to pay that 16 lakhs at the end of another 5 years. So I think that should be at 10%, 0.621. So let's see what is the present value of only the principal repayment at the end of 5 years, 993,600. So this is the present value. And now we need to consider step 3, the variation in terms of the percentage. So we go to the step number 3 and let's see what is the percentage variation. What is the percentage variation between the step 1 and the step 2? So I think if I take the variation, it is 10 lakhs versus 993,600 over the base of 10 lakh. I think it's coming to a percentage change of 0.64, is it? Oh, sorry, I missed out another thing. There is another 50,000. I forgot there is a TC as well. We need to consider the total outflow. So this is 993,600 plus another 50. That is 10,43,600. So that is 10,43,600. So the variation is 43,600 over the base of 10 lakh. And I think it is coming in terms of percentage, 4.36%. The variation is below 10% this time. And if the variation is below 10%, that means we are going to apply the concept of modification accounting. This is what the 10% test is going to decide, that whether we need to apply extinguishment or a modification accounting. Once you say a modification accounting, it is not a removal of the liability from the books of accounts. The existing liability is not to be recognized this time. And you know what? Something interesting. If you look at the concept of modification accounting, the standard is silent. Ind AS 109 is silent in terms of how the modification accounting is done. So in this particular case, there are 2 alternative acceptable practical treatments which are given in the study material. So I think let's make a walkthrough in terms of how the modification accounting is going to result in this particular case. So let's have a look at the modification accounting which is to be done. So I'm just going to take you further. Okay, I think let me explain it directly only. Let me explain the alternative one in terms of how the modification accounting is going to take place in this case. Now, you can see an interesting treatment is going to come when a modification accounting is applicable. In this case, now imagine the bankers are agreeable to modify your terms merely around 4.36%. I believe if the variation is 10 or more than 10, it indicates that you're really a bad defaulter and you have asked me for restructuring. and if the variation is below 10%, it means that you're not really a bad defaulter. And in this particular case, the standard says a very good treatment. Your book value of the liability is supposed to be 10 lakhs as of now, and you're incurring a TC to the extent of 50,000. So do one thing. Since you have not been a very bad defaulter, let's reduce your FL by the amount of TC. We're going to reduce your FL by the amount of TC, which means you're going to get a new book value. And the new book value is 9.5 lakhs. The new book value is going to become 9.5 lakhs. So the standard gives you an advantage in terms of making a reduction of this TC from the existing value. But the moment you're going to do that, you're going to make a reduction of that 50,000. This will again trigger the need of calculating a new effective interest rate as well. Because your 10 lakh figure is based on a 10% rate, and the moment the company makes a reduction of this 50,000, you're going to calculate a new EIR. So we're telling them, boss, it's okay. Let's continue with your existing liability because the variation is not huge, but let's change the amount of effective interest rate. So in this particular case, you need to calculate a new effective interest rate. But the question arises, how would you calculate a new effective interest rate? That's interesting. You know that the book value has become 9.5, and you need to compound this 9.5 to a total of 16 lakhs, which is payable as per the new term. So you need to consider that once that 16 lakhs is paid, I need to ensure that 9.5 lakhs should be standing at present value of 16 lakhs today. I put it again, I need to ensure that since the ultimate liability which you're going to pay is going to be 16 lakh based on the new terms, you need to ensure that this 9.5 lakhs will compound to a total of 16 lakh. If this book value of 9.5 is going to compound to a total of 16 lakh, you need to indirectly ensure that 9.5 is the present value of 16 lakh. So what is the discounting rate at which the present value of 16 lakh is equal to 9.5? So can you please put that once again? I'll add that again once to you. So what you've done, you've taken a revised book value. You've taken a revised book value. And this is to the extent of 9.5. So you took the book value of 10 and you reduced the 50,000, whatever is the TC incurred at this point of time. Now the problem is that this is the book value, but ultimately what is the final payment? What is the final payment after 5 years? The final payment after 5 years, in this case, is going to be 16 lakhs with no outflows in between. The final payment is going to be a total of 16 lakh with no payments in between. Because they've agreed on the modified terms that I'm not going to pay any further interest payments, and a final repayment of 16 lakhs is made. So which means we need to apply a basic common sense logic that you need to ensure that this amount, we need to ensure that this amount in the books compounds to 16 lakhs. You need to ensure that this amount has to compound to 16 lakh based on amortized cost accounting. Because at the end, if you're going to pay 16 lakhs at the end of 5 years, so whatever is the book value today in the books of accounts has to compound to 16 lakhs, so you pay that money. So we need to find out what is the rate. We need to find out that what is that rate at which you're going to compound this at 16 lakh. So we're going to do something like this. If this compounds to 16, which indirectly means that the present value of 16 lakhs should be equal to 9.5 lakhs. Because if you're saying that this money compounds to 16, indirectly it means I need the data that when is the present value, what is the rate at which present value of 16 equals 9.5. I'll get a discounting rate. So which means you need to now get the discount rate. You need to get this effective interest rate, which is the new rate at which the present value of 16 is equal to 9.5. So, but how are we going to calculate that? Very simple. What are you going to do in financial management? 16 lakhs into a PVIF, which is at a given rate at the end of fifth year end, which is at a given rate fifth year end, is going to be equal to 9.5 lakhs, right? If I apply basic financial management, I can say 16 lakhs into the present value factor, which is at a given rate for fifth year end, is 9.5. So let's see this mathematically. We can say if I calculate this, this is going to be, you can say, coming equal to 0.59. This is 0.59375. If this is 0.59375 in financial management, you could look at this in terms of table A3. You could look at this in terms of table A3. Now I'm teaching you financial management. So you would look at this factor in terms of table A3, that what is the rate at which the fifth year end figure is approximate. What is the rate at which the fifth year end figure is approximate to 0.59375? So if you're going to look at the table A3, you are going to get an amount, I'll tell you, equal to what? You are going to get an amount equal to almost 10.99%. This is one way. This is one way of calculating things. The other way is that you do a simple interpolation. The other way is do a simple interpretation. So let me also give you an alternative way of calculating this IRR. On one hand, you take the cash outflow, which is 9.5. On the other hand, you take a cash inflow, which is 16 lakhs, and do interpolation. You already know that the contracted rate is 10. Take 10 and take 11, get NPV. So get the NPV at 10%. And get the NPV at 11%, and then you can interpolate and get the answer. You're going to get a positive NPV at 10, which is 50,000. You're going to get a negative NPV at 11. Interpolate between the two. Once you interpolate between the two, you're going to get the answer 10.99%. So you can do it this way, or you can do it this way, whatever suits, though this is all financial management. So this is the treatment which is given in terms of modification accounting, that once you say that a 10% test is failing, you need to basically reduce the TC from the existing book value of the liability, and immediately it will trigger the need to calculate the new effective rate of interest, so that you can keep calculating the interest on the liability and it compounds to 16 lakhs at the future. I hope, friends, I have made my picture very clear. Okay, and I guess duration 5 years, and it is correct. Okay, that's great. That's great. So now I think let me pen down these treatments as well. So now let's, I think, make a summary of the concept in terms of the 10% test, the modification, and the extinguishment. So I think this will summarize the entire picture in a go. So let me summarize the inputs in terms of liability. Derecognition FA is done. Derecognition FL is done, except for the documentation. The entire concept of derecognition is done. So let's make a quick mind map on the derecognition before we do our discussions further. So let's see what is to be done in terms of derecognition of financial liabilities. So let's see what is done in terms of derecognition of financial liability. So I would say what you need to do, first of all, you need to apply a three-step model. What do you need to do, first of all, three-step model, and let's pinpoint the key areas which you need to keep in mind. So when you go to the step number 1, you need to calculate the present value of the original cash flows, and you need to consider the remaining cash flows. So the focus point in this particular case is, you need original and you need remaining, and you need to consider the present value on original EIR. So again, 3 focus points. Yes, original terms, original EIR, remaining cash flow. Then you go on to the step number 2, and in terms of step number 2, you again consider the present value of the new cash flows. You need to consider the present value of the new cash flows which are there. And now the focus point is back again clear. You need new cash flows, and you need to take the present value again based on the original EIR. So you take the original at original rate, you take the new at the original rate, and then you go to the step number 3. And in terms of the step number 3, you need to calculate a variation. So this is a 3-step model which is applied on a 10% test to be conducted. And once you apply this 10% variation, you would get the results. The variation is 10% or more, or the variation is below 10%. So either the variation is 10% or more than 10, or it is below 10. If the variation is 10% or more than 10, it would mean an extinguishment accounting. It would mean an extinguishment accounting. And if you say it is below 10%, it would mean a modification accounting. In this case, it would mean a modification accounting. So this test will give you the idea of which kind of accounting is to be applied. And another important aspect, when you consider the new cash flows, in this case, we should also include the TC as well. So even the step number 2 is got 3 focus points, like step number 1, remaining original rate, and the step number 2, new original rate, including TC. And that's how you remember step 1, 3 focus, step 2, again 3 focus, that new cash flows, original rate, including TC, and you get a variations to decide. Once the 10% test is done, then you go further and you decide the kind of accounting. That if it is extinguishment, what happens, and if it is supposed to be modification, what happens. So if there is going to be an extinguishment accounting, then what? And if it is supposed to be a modification accounting, then what? So if you're going to consider an extinguishment accounting, it's time to de-recognize the FL and recognize the new FL at values. So financial liability, which is the old financial liability, gets de-recognized at a book value. The new financial liability gets recognized, and this is going to be recorded at a fair value. This is going to be recorded at a fair value. Remember, not fair value minus TC. Is going to be taken at a fair value, not at fair value minus TC. And this fair value is going to be the present value of the new cash flows. It is the present value of the new cash flows. And this present value is based on the new effective interest rate as well. The market rate of interest which is prevailing on the date of the modification that is to be taken. And then what you need to do, any balancing figure in this entry is going to be taken in the P&L, and you can put another separate entry for the TC. So you can put another entry for the transaction cost incurred, maybe separately. The TC gets a debit and the bank gets a credit. It is TC debit. It is not FL debit. And this TC ultimately is going to be debited in the profit and loss account as well. So this is the entries which will be done for the extinguishment accounting purposes. Then comes the concept of modification accounting. In this particular case, what you need to do, you are going to pass an entry, FL gets a debit and the bank gets a credit. And this is to the extent of the TC incurred. So if you ask me in journal entry forms, I would say that 50,000 incurred, you put the entry FL debit and the bank gets a credit for the TC, and this will trigger. And you can say this will trigger the need. This will trigger the need to compute. It will trigger the need to compute, you can say, the new EIR for the purposes of interest in the future. Immediately as you reduce the TC out of this FL, it will trigger the need of calculating the new effective rate, the 10.99. Right, friends. So that was on the accounting treatment as far as the extinguishment and the modification accounting is concerned. Wow. I hope you're absolutely crystal clear now on the accounting as far as derecognition of FA, derecognition of FL, and all is concerned. The principles which will decide the derecognition of FA and the three kind of accounting, the 10% test for FL and the corresponding accounting extinguishment and in terms of modification. Okay, so I think now let's go further. Okay, I think so far so good. No more questions coming in. You must be thinking, day by day, the financial instruments intensity is increasing. Yes, of course. But we are still now left with some more areas of discussions with you. Now let me come back to the picture and let me know what is now my next area of discussions. We have done the entire concept, but there is now some special situations to be discussed and the special issues which we need to discuss in terms of accounting. The special issues which we need to discuss in terms of accounting is going to be threefold. And I want your inputs also in terms of what you want me to discuss in the next class. One is the area which is as far as derivative accounting is concerned. The concept of derivative accounting, and this derivative accounting would lead to impact. I would like to put it like this. Let's not put it as a derivative accounting. I would say derivative accounting is on the background. I would say the derivative accounting is on the background. I've already explained you the derivative accounting. Not the derivative accounting, but I've given you the features which are there in terms of derivative. If you remember when we were talking in terms of the three-step model, in terms of Index 32, I gave you that derivative has got three features. One is that the value depends upon an underlying asset. The initial investment is negligible or it is zero. And there is a future settlement which decides a derivative. So now we need to understand the derivative accounting. So we will understand the derivative accounting is done at FPTPL. Derivative is supposed to be risky instruments. And if they're supposed to be risky instruments, in this particular case, the entire accounting is based on FPTPL. Now, this derivative accounting is going to help me in two areas of things. One is it is going to help me in terms of understanding the accounting for embedded derivative. It is going to help me in understanding the accounting in terms of embedded derivative. Not much, but yes. And I think let me remind you that this embedded derivative is the concept of what we call hybrid instruments. So we said that we're looking in terms of hybrid instruments in this case. That when a company is entering into contracts, which are a blend of a non-derivative and a blend of a derivative, we need to see that how this concept is applied. So this derivative accounting will help me in terms of understanding how the derivative component of these hybrid contracts are accounted for. Is there a need to segregate the derivative embedded in the instrument? And if the segregation is done, how does the accounting of the derivative embedded, which is taken out, accounted for? This derivative is also going to help me in terms of deciding another accounting, and that is called a hedge accounting. It is also going to help me in terms of deciding the hedge accounting, which means I need to first explain you a derivative accounting at the background. And this derivative accounting is going to help you in two special areas. One is on hedge accounting and one is on the area that is in terms of embedded derivative. And then comes a different area, not based on a derivative accounting, and that is based on what we call impairment. Doing an impairment testing in terms of financial assets. If you recall, the impairment is covered in a separate standard IS 36 as well. But IS 36, I'm saying, Ind AS 36. So when you're looking in terms of impairment testing, the non-financial assets of a company are impairment tested under Ind AS 36. But when you look at the financial assets of the company, they are impairment tested under Ind AS 109. So we need to understand the concept of impairment testing, which is popularly called the concept of ECL, that is called an expected credit loss. Well, all these areas now a bit technical. So of course, the next two classes are going to be technical. So what do you want me to do in terms of priority discussion? You want me to first discuss the derivative, hedge accounting, embedded derivative, and then go to impairment, or you want me to first go discussions on impairments and then derivative? So as you decide, if you tell me that I'm going to go to impairment, I'll explain impairment and then go to derivative and maybe give you a little inputs on hedge. But then the problem is that the next class in that case can become very heavy because I don't want to cover both of them in single class. So my idea is that what I am planning is that I would cover, first of all, a derivative accounting and do the concept of hedge accounting to you. And then we can maybe discuss, if time permits, in terms of bit impairment. If not, then we can cover up the hedge accounting impairment in the next session with you. Because our next session is not there on Thursday with you. The next session is going to be on Saturday and then followed by another class on the next Tuesday. And that would finish the financial instruments. So let me get your input, friends. What is your inputs on that? No inputs on that. I didn't get any message, which means I am free to decide what I want. I think if there's nothing coming your way, then I think I choose what I decide to do, right? Anyway, I think that seems to be quite good for the day. So these are the three areas which are pending for discussion. If you look at hedge accounting, there has been only one practical illustration which came in RTPs, not in the exam so far. Embedded derivatives, yes. Impairments, not really much. But I think we still need to do that. So let's see if some inputs coming. Otherwise, I decide further. No inputs coming. Everybody's too tired on the day. Right, friends. So I think then it's time to bid you goodbye. So I'm going to see you on Saturday and we're going to decide, what we're going to cover. Most probably, I'm going to start in terms of derivative accounting and explain the concept of hedge accounting on that day. So that's all for the day, friends. Thank you very much. I'm going to see you back on Saturday. Take care. Bye-bye. Thank you.